Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous?
Hey, welcome to Modern Investing Techniques, episode 75 for June 13th, 2026. I'm Patrick, coming to you from Vancouver. Let's look at what the markets are telling us today and find some opportunities. Quick reminder, everything we discuss here is for education and entertainment. The practice investment of the day uses simulated trades with no real money. I'm not a licensed financial advisor, and this isn't financial advice. Always do your own research before putting real money to work. PPI at plus 6.5% makes defensive consumer staples like Coca-Cola worth adding to TFSA watchlists for inflation protection. The S&P 500 closed at 7,431, up 0.5%. The NASDAQ finished at 25,889, up 0.3%. The TSX Composite ended at 34,938, up 0.8%. Sentiment draws support from expectations of a U.S.-Iran deal within 24 hours that could ease energy price pressures. The Bank of Canada's next decision sits on July 15th, with markets pricing in steady rates near 2.75%, while the Fed faces uncertainty on whether any Iran-related oil relief will prove dovish. Earnings season is quiet this week, with consumer staples showing relative strength against producer price inflation and energy lagging as deal hopes reduced geopolitical premiums. Our simulated portfolio sits at a cumulative profit of $396.68 across 34 trades, with cumulative alpha versus the NASDAQ at plus 21.2%. That macro setup leads directly into the exact screening method we're highlighting today. Inflation-protected equity sleeves use companies with strong pricing power to offset rising input costs. Today's 6.5% PPI print highlights why investors should screen for firms that have historically passed costs to customers without volume loss. Start by pulling the last 8 quarters of gross margin data in your brokerage screener, then filter for names where margins expanded even as PPI rose above 5%. This approach worked best during the 2021 to 2022 inflation spike, when staples outperformed growth by 18 percentage points on average. The main risk is valuation compression if rate cuts arrive faster than expected. Build the sleeve inside a TFSA to shelter the dividends that often accompany these names. We're putting that exact approach into practice with today's simulated trade. This is a simulated trade for educational purposes only, with no real money involved. Today's practice investment is a weekly hold in Coca-Cola, ticker KO, on the NYSE. The catalyst is the 6.5% year-over-year rise in the producer price index, which creates a tailwind for firms that can raise prices without losing volume. The technical setup shows the stock trading above its 200-day moving average on daily charts, with volume running near the 20-day average and nearest support at the 50-day moving average. Risk assessment notes that a faster-than-expected Fed pivot could pressure staples valuations, so the stop loss sits at 6% below entry to cap simulated loss. The target is plus 2% to plus 4% over the 5-day hold window. Is medium because the PPI data and pricing power history align, yet sector rotation risk remains if growth stocks rebound sharply. This trade demonstrates how to screen for inflation-resilient names using public economic releases rather than hype. Before we check how last week's trade performed, here's the lesson we're carrying forward. Last week's simulated hold in Eli Lilly entered at $1,159 on Monday's open and exited at $1,160.95 on Friday's close. The position gained 0.17% or $1.68 on a $1,000 stake. That result fell short of the NASDAQ's roughly 1.5% gain over the same window, producing negative 1.33% alpha. The position held a narrow gain but lagged the broader market as rotation favored other sectors. The new rule requires both a fundamental catalyst and a volume spike above the 20-day average before committing capital to healthcare launches. That discipline around durability brings us to a bigger historical parallel. Imagine you bought a high-flying AI infrastructure name last month on the back of a single large contract announcement. Your order filled at the opening print, but the stock gave back half the gain by month end because revenue visibility was thin beyond that one deal. The mechanism is identical to 1999 and 2000 when investors bought click stories with little free cash flow, only to watch multiples collapse once growth slowed. The pro tip is to demand at least 3 years of visible revenue from existing customers before sizing above 3% of the portfolio. Professionals always run a simple discounted cash flow check on the incremental revenue before adding. The biggest mistake with AI stocks today is treating every revenue headline as proof of durability. Instead, always separate companies already generating positive operating cash flow from those still burning capital to chase market share. While we apply those filters manually, here are 2 platforms that can speed up the work. Investing Pro fair value models flag stocks trading at least 30% below model-derived fair value and have already highlighted names that later surged 69%. Canadian investors can run the same screen inside a TFSA to surface mean reversion candidates without paying for premium data elsewhere, with access to the free tier at investing.com/pro to test the models on up to 5 tickers per day. The Motley Fool Stock Analyzer lets users compare forward revenue growth against current enterprise value for small cap growth names and surfaces ideas like the 684% revenue jump at one AI adjacent firm, while showing the cash burn trajectory. Use the free trial to run side-by-side comparisons before committing capital. Those screens are already surfacing names in our quick hits. Bitcoin ETF outflows have now reached record levels according to the latest data. Heavy redemptions continue to signal ongoing institutional caution. Price levels remain near multi-month lows even as selling pressure intensifies. This pattern points to sustained risk-off positioning among larger holders. Any crypto allocation exceeding 5% of TFSA holdings warrants trimming at this stage. Adjustments should remain on hold until weekly ETF flows register positive readings. The details appear in reporting from Fool.com. Solana currently trades at its lowest level since December 2023. The network still ranks among the top 5 chains measured by activity metrics. Price movement mirrors the wider risk-off tone across digital assets overall. Investors may want to add SOL to an active watchlist for monitoring purposes. Dollar-cost averaging entries require a weekly close above the December 23 low first. This threshold serves as a clear technical filter before any new commitments. The observation is drawn from Fool.com. SoFi Technologies carries a forecast for doubling within the next year. Its current fintech valuation sits at beaten-down levels that create room for asymmetric upside. Loan growth and member metrics would need to maintain their recent inflection to support that path. A limit order placed 5% below Friday's close fits well inside an RRSP structure. The approach supports long-term compounding without requiring immediate full deployment. Valuation compression in the sector has left the name with limited downside relative to the projected rebound. The projection originates from Fool.com. Teladoc experienced a 69% surge after quantitative models identified it as deeply undervalued. The move followed the stock trading at least 30% below model-derived fair value. This outcome illustrates the practical edge available from systematic fair value screens. Similar healthcare names currently sit 30% or more below their model values. Volume confirmation above the 20-day average remains a prudent filter before action. The episode highlights how screening tools can surface opportunities ahead of sharp repricing. Coverage of the surge is available at investing.com. Finally, put the PPI lesson into action yourself with today's listener challenge. Open your brokerage screener, set PPI surprise greater than 4% as a filter, then add the top 3 consumer staples names that also show positive gross margin trends over the past 4 quarters. Review the list for 5 minutes and note which one trades closest to its 200-day moving average. Our simulated portfolio across 34 trades shows a 59% win rate, with 20 wins, 11 losses, and 3 break-even outcomes for a cumulative profit of $396.68. Average return per trade sits at plus 1.17%, with the best trade at plus 20.11% and the worst at negative 11.35% on a current streak of 1 win. The AI analysis continues learning from patterns like the need for volume confirmation and sector rotation signals. Before we wrap, keep an eye on whether the expected US-Iran deal materializes and how energy names react on Monday. That wraps up today's modern investing techniques. Remember, every trade is a learning opportunity, win or lose. Subscribe, share with a friend who wants to invest smarter, and we'll see you tomorrow. And if you'd rather watch than listen, find us on YouTube at NARA Network. Links in the show notes. And before you go, this show is part of the NARA Network, a family of daily podcasts covering tech, science, markets, and more. If you enjoyed today's episode, give Models and Agents a listen, your daily briefing on AI models and agents. You can explore the whole lineup at naranetwork.com. This episode used AI voice synthesis of my voice. Editorial selection and analysis are my own.
Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous? Do you ever stay awake, counting sheep like all the time? What's your life like? What's your purpose? When's your birthday? What's your sign? Are you down right now? Are you stuck up in the past? Are you still thinking about all the times that you didn't laugh?